Recorded. Thanks for joining us. And I'm going to begin by introducing Adam Kaufman, co-founder and managing director of Arbor Crowd. Adam, thanks so much for joining me.
Yeah, hi Sam. Thanks for having me, and thanks everybody who tuned in for this.
So we worked together last year to prepare a case study, again, that was circulated to students that are participating in today's call. We'll run about an hour, and there are three main areas of discussion that we're going to work through. First, we're going to talk a little bit about the foundations of crowdfunding. Where did it come from? How long has it been a feature of the real estate market? How significant a feature of the real estate market is it? What are the types of properties that crowdfunding companies are investing in, and who are the investors, both accredited and non-accredited, that the crowdfunding platforms are working with? Then we're going to really get to the meat of the case study itself. And we're going to talk to Adam about his experience in starting Arbor Crowd, what the competitive landscape looked like at the time that the company was started. What was the competitive advantage that Arbor Crowd saw as an opportunity for entering the market, and what were some of the challenges in not being the first entrant to the real estate crowdfunding space. And then I think we're all very interested in hearing, Adam, your insights on where we are with crowdfunding now, how it's been impacted over the last 6 to 8 weeks as the pandemic has really taken hold of economic activity and real estate markets in the United States, what you anticipate the next couple of months will be like, and how crowdfunding might look a little bit different on the other side of the pandemic as compared to where we were in January or February of 2020. A reminder to folks on the call, we do have the chat function available. So if you do have questions for us, Adam and I are both going to be watching the Q&A box. Please do just lob over some questions over there, and we will make sure to answer them in line as we're going through the discussion. If you did not get a copy of the case study during advanced registration, then we'll make sure that you get a copy of that when we make the recording of today's webinar available. Adam, if you can start us off in the most basic terms, what is real estate crowdfunding?
Sure. So the advent of real estate crowdfunding came about in 2012 with the passage of the Jobs Act. And what it essentially allowed for, what's happening today, is allowing companies to raise money online from accredited and non-accredited investors alike, depending on which model you operate under as a company, to invest directly into commercial real estate transactions or funds that invest in commercial real estate transactions without going through the traditional, means of a broker or financial advisor of the sorts.
So you mentioned the Jobs Act, 2012, passed with bipartisan support under President Obama, as described in the introduction to the case. What is the Jobs Act? Why did it happen when it did? And why was it important? Because it seems like the underlying technology to raise money for real estate online was already there. What changed with the Jobs Act?
Sure. So the Jobs Act, the Jumpstart Our Business Startups Act, essentially wanted to, was passed essentially to create opportunity for small businesses of the like and different sources of capital raising and contribution through direct investment. What do I mean by that? So for the first time, technology, like you said, Sam, played a role for people to access a tremendous amount of information. You no longer needed to rely on third parties to provide information and be a part of networks or groups or whatever it was to access that. You could research and do a lot on your own. You could Google things, you could go to different websites, you can browse, you can get information of all different sorts. So with technology progressing and access to information progressing, essentially the Jobs Act created the ability for people to go out and raise funds directly from consumers. Prior to the Jobs Act, there was, some would say, an outdated ban on what we call general solicitation. So what that meant was that in order for you to raise money in towards any sort of investment, real estate or non-real estate, you had to establish a first degree connection with somebody. They had to essentially be in your Rolodex, let's say. So with the Jobs Act, that removal of that ban on general solicitation allowed for people to access, direct investments or investments, right, through technology, through the computer, without having that first degree connection already established.
Is there anything significant about the timing? We don't hear very often these days about new legislation being passed in Washington with bipartisan support. Was this something that came about because the technology had arrived, because there was greater flexibility in our thinking about how to regulate the raising of money, or was it in part motivated by a desire to help spur job creation during a relatively lackluster jobs recovery?
Exactly. You nailed it. So we were, 2008, 2009 happened, and Congress recognized that they wanted to further, create job opportunity to progress the economy in the likes, right? On, coming out of the crisis. And one of the ways to do so, which, like you said, had bipartisan support, was the Jobs Act to create opportunity. A lot of people, the market was down. Politics is a funny thing, as we all can say. When the economy is doing well, the incumbent in Congress, they stay in seats of power. They stay where they're at. And a lot of what was happening was to help the economy to continue to grow and prosper. And that was the intent of the Jobs Act.
So, a few more foundational questions so we can really get our hands around exactly how this works. Are crowdfunding companies raising money in terms of the capital stack to make debt available to investors, to provide equity, both? Where do they fit into the capital stack?
Sure. Crowdfunding is a funny thing because it really opened the door for any type of solicitation or investment, and that includes both in the commercial real estate landscape, debt and equity alike. But even earlier on in, right when the Jobs Act came to be passed, you saw companies like Kickstarter, Indiegogo, for example, come and launch products for people to invest in, that they didn't necessarily see a return on that investment. There was no money coming back to them. It was a concept, it was an idea that they helped progress and invest towards. Even today, you see a lot of people, raise money for charities or right now, coronavirus victims, right, and their families. All of that is a result of the Jobs Act and what came into existence. Specifically for commercial real estate, you see hundreds of players, and this is part of something that I hope we have the opportunity to discuss in this hour, is that you have so many people who could enter the market with very little experience, and they could enter and solicit debt investment. They can solicit equity investment, and they could be mom and pops creating a website anywhere all over the country for an individual transaction, whatever that asset might be, or whatever asset class it falls into. Or they could be more institutional, more legitimate, colloquially, as we could say, and really go to market, and leverage this opportunity to make people, to get people into some serious investment opportunities.
So, you mentioned both accredited, non-accredited investors. Just explain what
A
you mean.
non-accredited investor, varies, but really could be anybody and everybody, right? And different platforms in different states have minimum net worth or income threshold requirements, but the barrier to entry is significantly lower.
And in terms of the properties that folks are investing in, so on one hand, you've got either accredited or accredited, the platform acting as an intermediary. In terms of the properties that you're making capital available to, whether it be debt or equity, have we seen over the last couple of years as crowdfunding has matured as a platform? Is it heavily multifamily? Is it on average relatively smaller assets? Is it typically riskier or less risky investment opportunities?
Yes, that's a fantastic question, in that I think it's actually beneficial to take a step back and say, who are the companies, who are the players, and what are their expertise, right? So a lot of companies that came quickly into existence with the advent of the Jobs Act are what I call aggregators, marketplaces, right? And they view themselves, and a lot of people in this industry do that right now. And that's a little bit of the problem, something that I've been actively talking about for the past year or two, something that's incredibly relevant to where we are in this pandemic and how people are faring and how opportunities are faring, right? In that these aggregators, these marketplaces sell multiple asset classes with differing sponsors, business plans, and execution, right, on their platform. And you have to beg the question now, what is their experience in, underwriting or analyzing these assets, right? These across different asset classes, right? And how are they kind of putting the deals that are being applied to enter the marketplace through an analytical base or medium, right, that meets a certain standard? And the answer comes down to, for us who've been in the industry for a very, very long time and who have decided to launch our company, putting the product first, not looking at ourselves as technology companies, marketplaces, aggregators, or anything of the like, but truly looking at ourselves as real estate companies, we understand you cannot be an expert in every asset class and every differing property type. And I think what's happening right now is you have these platforms who identify as technology companies putting out an enormous menu of opportunity for investments, right, to people who a lot of whom have never made investments in any sort of real estate, commercial, residential, debt, equity, retail, hospitality, multi, right? They're offering all these sorts of opportunities, right? And they're being presented by companies that they don't really have the experience or expertise to really evaluate these deals to see if they meet a basic threshold, whatever that may be, to be on their platform. And I think when you have, I've been talking about it for a while, like I said, but when you have a pandemic, when you have a downturn, whatever that facilitator is, unfortunately, no one could have predicted this, but it really comes to question the performance and capabilities of a lot of these deals. And ultimately they're looking and saying, who were the experts that presented it to me? What was the due diligence, right? And, when you try to bite off more than you can chew and you try to, launch a lot of different asset class, a lot of different business plans onto your marketplace and opportunity, right? There's a lot of inherent risk there. So in short, the answer, yeah.
So, but a question here. So, it sounds like it's important that you've got folks that know real estate, to underwrite these deals and to facilitate, this marketplace. But on the other side, you've got, an audience of investors that may not have real estate expertise. How are you able to communicate to the potential investor, whether it be accredited or non-accredited, that these are important, features and skills to have embedded in the team? Is the consumer investor able to differentiate one crowdfunding platform from another?
So that's a great question as well. And, I always recommend to the consumer, evaluate who you're partnering with. Who are you doing business with, right? What's their track record? What's their experience, right? And are they trying to be everything to everyone? Because anybody who tries to do that is not going to be successful, right? In a hyper vertical situation. So what do I mean by that, right? Different models afford different levels of transparency and communication for investors. The model in which we operate under, we focus on doing one deal at a time. We close on that transaction. We write the check for that transaction, right? Before we syndicate out the investment to the crowd. What does that mean? Because we've closed on the transaction, because money is already in the deal, we're able to present a great amount of information to investors to access, right? And the information is not changing. It's not static, right? So they're able to access that information in a great amount of detail. We're able to communicate it very transparently in a large prospectus that we offer on our platform, right? For people to make investment decisions. When you have other platforms out there, right, you either have a fund model where they're saying, hey, we're raising up to $50 million. I'm not going to get overly technical in describing this, but we are raising up to $50 million and we have a broad strategy. We are going to invest in multifamily properties in the Northeast. I call that a tear sheet, right? There's very little communication. there's very little detail and transparency. And ultimately, you're dealing with an investor class, like you said, Sam, right, that has not invested in real estate before. They're new to this, right? So what if this investment goes south? What do those investors say to themselves? They say, who presented me this opportunity, right? What was the information that was given to me when I invested in this opportunity, right? Who are they going to blame? Who is the SEC going to go and protect, right? And that's the types of problems that we're facing. And especially when, we're in a downturn, crowdfunding has only existed in an upcycle. Now, we're entering a different period. Deals will not perform. And investors are going to start asking, what did I understand or what did I know when I went in and made this investment?
So the heart of the case study really gets to sort of your starting Arbor Crowd and what market conditions were at the time, what you saw as the opportunity. I want to get into that next with a couple of questions. Before I do, one from one of our student listeners: when crowdfunding companies are providing, equity, maybe to fill out the capital stack, is there one answer for where the debt is coming from? Are your investors on the property investment side also working with a bank or a non-bank financial institution to fill out the debt side if you're providing the equity?
Sure. Different platforms have different business models. Most platforms are providing LP equity, right? They don't have a great amount of say over a lot of the decisions that are being made on a day-to-day level and even on the debt terms, right? And where the industry's at right now, and the way that crowdfunding is able to enter the capital stack, is in a way where it affords the opportunity for pretty much any sort of debt to be taken on a property, whether it be anything from the GSEs, Fannie, Freddie, FHFA, or going to traditional banks, CMBS backed debt, right? All those you're able to do that. There are different restrictions that are pretty nuanced and guidelines that are issued by the different forms that you can go after, but all pretty much afford the opportunity. The question that is being asked really is more so, are crowdfunding investors or platforms able to have a say in the types of debt that's being offered on a property level or that they're entering into on a transaction level? And the answer usually is no, because of the fact of the way that the crowdfunding equity gets invested and how they partnered. It's mostly LP equity. You're JVing with what you would want to be experienced people running the day-to-day, and they will want to make the decisions on the types of debt that they're taking on a property level.
So you come to this market. There are already incumbents. We've seen the first couple of firms enter the crowdfunding space after the passage of the Jobs Act. What year is it that you decide that Arbor Crowd is going to enter this market, and what in particular did you see as the competitive gaps that would create an entree for you?
Yeah. So essentially, the market really came into existence starting in 2013. It took some time after the Jobs Act for companies to form and understand the capability for real estate investment to come in on a commercial level. And a lot of companies in the beginning who continue to today to identify as technology companies, something I hit on a little bit earlier, right, rush to the forefront to figure out and say, how can we create a company? How can we create a platform? They went to VC companies, they had an idea, they got a lot of investment, they started these companies. And what they launched with, right, on an individual deal model level, which we currently still operate on, is saying, hey, let's go to approach different sponsors. That's what we call the GPs in the deals, right, in our industry, and say, hey, we have equity for you, or debt, whatever the platform's focus is, right, to co-invest with you or to give you money, right? And there were a lot of limitations in the industry at first. And a lot of the problems that the platforms were facing were that how can they attract quality sponsors when at the closing table, they don't have the money, they have to go back and raise that money, right? They couldn't do it because if I'm showing up on closing day and I'm saying, hey, I can give you, $5 million, and the sponsor says, great, where's that money? They're like, hold on 1 second, let me go raise that. And what if I don't? You're never going to get a deal closed. So what happened was this new model, this new ability to raise money in a fund structure up to $50 million, known as the Reg A Plus model, came about. And in 2015, that was widely adopted to solve for this issue, so that they could raise money up front, up to $50 million in a fund, and then deploy that capital. The cost to doing so was astronomically high, and the amount of transparency and communication that you could give to investors was not there because you didn't identify the assets yet, right? We were on the
Why was
sideline
the cost high?
because you have to. It's an incredibly costly to not only just source investors through different channels to launch these companies that some of them launched on day one 40, 50, 60 employees, right? A tremendous amount of overhead. They had to show a tremendous amount of growth of the VC companies to continue to get backing, right? And on top of that, for the first time, they have to spend a lot of money to attract sponsors. They didn't have a name in the industry. They didn't have a legacy. They didn't have a built-in network. They had to go and attract sponsors and source deals, right? So you're hit on two ends with a lot of cost, right? And it's a cost-heavy industry. While this was happening, I was sitting on the sidelines watching because I knew the first companies out the door were going to go through the typical trials and tribulations. Let me see how that pans out, right? And I watched very closely. At the end of 2015, we actually did a deal with some crowdfunding platforms to see, how they worked out. And in 2016, I officially launched the company January of that year. We launched a soft deal to the market in July of that year, really to family and friends. And listen, that's how you grow a business. You start, you need a proof of concept, you get going. And then the beginning of 2017 is when we full-fledged got up and running and launched further transactions onto the platform.
So two questions for you here. If you're not going the Reg A model to raise that larger pool of money that allows you to execute, how are you addressing that basic problem that might otherwise arise? And then also a question from one of our students, that first deal that you bring onto the platform, or even any subsequent deal, what criteria are you using when deciding what's going to show up on the platform? Start with the Reg A plus, please.
So this is a long answered question, so interrupt me as you need to. So we identified so let me take one step back. Arbor Crowd is part of the Arbor family of companies. Arbor Realty Trust within the Arbor family of companies is a publicly traded real estate investment trust. They're also licensed by Fannie and Freddie as to facilitate debt and also service that debt. So there's a built-in network that we started, a built-in experience through the family of companies. And what we identified when we started this company in our very niche business plan was that there were borrowers coming to the REIT, right, who were short a few $1 million often on transactions, that they would then have to turn around and raise that money from family, friends, family offices, high net worth individuals. And that was very burdensome for them. And the REIT was seeing this over and over again from borrowers, and they needed a way to close that equity gap. So Arbor Crowd launched as a platform with the intent of saying, we recognize that the commercial real estate industry has a need. That need is to close that equity gap. And that equity gap number normally ranges anywhere between $2 to $6 million. That's our business plan. That's what we do. And it is truly limited LP equity, right? That isn't looking to run the day-to-day of the property. That is the slice, right? So when we launched that company, we had a specific vision and we had a specific understanding, not what the Jobs Act allowed for to launch a company necessarily, but what the commercial real estate industry needed, right? And the type of capital that they needed that we were seeing through our experience. And that's a very important differentiator because many of our competitors didn't launch on that concept, right? They didn't launch thinking what the industry needed. They launched what they could bring to the industry. And there's a nuance and a difference in that approach and personality.
So quick follow-up question there. If you're describing a scenario where part of the business model is the sliver of the capital stack that needs to be filled out in an environment where, let's say, lending gets a little bit more aggressive, and so you need less equity, does that create a smaller number of opportunities for folks in the crowdfunding space if we just need less equity?
I don't see it that way because I think there is such a need for liquidity across the board and everybody's equity checks are going to be cut back depending on their positions. And if you have money to invest coming out of this or during this recession, because we do not know how long it's going to last, there is a great amount of opportunity, and the need for capital will be there. And we have that capital, and we will continue to deploy that capital. As we are looking at deals today, right? We're not launching deals in the platform because of the current environment, but we are investing in them. We are warehousing deals that we would otherwise be putting on the platform today. And I don't think the industry is going anywhere, and I don't think our business model necessarily is going away either.
So, part of the case is also focused on the first deal that Arbor Crowd, brought to market. To come back to this question from one of our students, how at that point and on an ongoing basis are you selecting deals for the platform? Is there a particular property type, scale, size, location that just really lends itself to the platform?
Yes. So like I said, we focused on multifamily, and I'll add to where we recognize the need for that additional equity, that $2 to $6 million slot, right, was really in the 20 to $100 million transaction size range. There's a lot of sponsors operating in that specific, in that specific range who have the need. So that's our business model, right? Traditionally, we focus multifamily, a lot of value add, ground up here and there, in Class B, sometimes Class C assets, right? In, let's just call them some primary, but secondary and tertiary markets, really developing, growing markets.
Now, is part of that because there's a greater need for that equity in those markets? There's less competition from other sources of capital. What are the features of those secondaries and tertiaries that might make them a better fit than, let's say, only sticking to New York and LA?
Yeah, so when you stick to New York and LA, right, the returns are going to be a lot thinner, and there's a lot more competition. And I think, you go outside those markets, there's a lot more opportunity. I will say before this, the past 4 or 5 years, right, there's been so much competition in every market since 2012, and independent of the Jobs Act, just in the commercial real estate landscape as a whole, a lot of players entered with little experience, but a lot of capital behind them, right? And with little experience, right, they were willing to pay crazy numbers. I can't tell you how many deals we were bidding on, and essentially somebody offered numbers, and we just said that your margins are so thin, you will not see a return. Any sort of change to the current market will really stress your margins. You will not see any upside there. If not, you'll be completely underwater, and we're starting to see that now, right, in this crisis period, very aggressively. So we recognize that with that competition, right, there was a lot of people in the market who are, I would just say, acting with little experience and irresponsibly to whomever their investors were. We took a very careful and cautious approach, which went in line with how I build a business, how I start a business, which is not being everything to everyone on day one, right? Building slowly and finding quality opportunities, because your investors on day one, if they're investors on your last day and your continuing day, right? That's the most important thing. That's longevity, that's continuity. So, that's the current, that was the landscape. I think where we are today, it's an entirely different one. And coming out of this, for however long this lasts, there will be a refresh or reset on the commercial real estate space as a whole.
So one of the questions that we've got from a student, and presumably this relates to sort of how you anticipated the business would function during normal times. What do hold periods look like for investors using the platforms? And are there models where there are returns and distributions related to the income itself, or are all of the gains sort of at the exit?
We have different types of models built in. Typically, we go for a 2 to 5 year hold period. That's what we're looking for. The IRRs on our deal that we were looking for, again, they were a little bloated by the crowdfunding industry as a whole, because hey, IRR sell. So when you're marketing online, through digital ads, whatever it may be, you throw a 20% IRR on, people are coming in and investing, and people are just comparing IRR to IRR to IRR. They're not looking at the interdependencies of what asset class, what market, what's the, how aggressive is lease up, whatever it may be, right? So traditionally, we look for mid-teens IRR net. So after our fees, deal level about 17 to 22 on a typical value add deal, let's just say. And there are the opportunity. Some of them, do have, you can see in a capital event such as a refi or an upsizing, you can see capital. Some of them are cash flowing depending on the business plan, and then some of them are longer, longer term holds that you'll ultimately see your money back at the end.
Now, you mentioned that you took a slow approach. You do one deal at a time. One of the questions in the case that students have to evaluate is whether or not there might be some benefit to scale here. Is there value in making sure that investors on your platform can choose from a range of deals at any given time? What was your thought process in choosing to do one at a time? And what do you feel like you might have given up, if anything, in taking that approach?
Nothing. And I'll tell you why. Because, there's such a common thought. And listen, I'm a millennial. So, hey, I have the thought too of how do I make money quickly? How do I launch a huge company, increase the value of that company 3-4 years later, have a crazy valuation and be a hot shot and a big shot on day, very quickly. That is not my approach. That is not what I'm doing here, right? I'm looking to build credibility as I find opportunity. We invest our capital into the deals, like I said, at closing before we syndicate it to the crowd. We put our money where our mouth is. One successful deal leads to another. One successful raise leads to another. You build your business, you build your investor base, you build your track record, your credibility, right? Slowly. I'm looking to be here in 20 to 30 years, still doing the same thing on a bigger scale. So while a lot of my competitors, right, may be out raising me, I'd be very curious to see how those transactions really phase during this time period, during a recession, right? And what their longevity looks like. Because I'm, at the end of the day, looking out for my investors and the opportunities that they're in. And by doing so, I need to act responsibly.
So if we go back to the start of the company, the business strategy decisions that you're making, what did you feel at the time would be your most significant challenge in getting the business off the ground?
You're always looking at how am I going to go out to market? How am I going to find more investors and attract investors? I had a lot of resource and ability, right, to find deals, but the market for deals was so competitive, like I said, right? So, we knew that deal flow in the beginning would be a challenge, but we have the patience, we have the commitment, and we have the capital behind us to take our time and do things as we saw fit. And that's the current position we're in. And that's why I'm able to join you here today and feel pretty good about the deals we're invested in. To have, 2 realized deals already under our belt in short timeframes that were executed very well, right? Showing showing back money to our investors earlier and higher than they had anticipated, and hopefully facing a few more events like that coming up.
So we've got a number of different questions to still get to, including sort of your views on where we are in crowdfunding right now. We've also got some questions coming in from students. If we don't get to your question during the webinar, then we'll make sure that we follow up. One of the questions, Adam, is about your criteria for committing your own capital. But would it be fair to say that if you didn't believe in a deal and if you weren't ready to commit your own capital, you wouldn't have brought it onto the platform in the first place?
Absolutely, because if that deal doesn't sell, who do you think's invested in it?
Next question I want to ask you, part of the case addresses that first deal. Just tell us briefly a little bit about that first deal that you did.
Sure. So we partnered with another member of the Arbor family of companies, AMAC, Arbor Management Acquisitions Company. They are a more traditional private equity fund that exists in this space. They run and operate their deals as the GP. We came in as LP equity. It was on the Upper East Side in Yorkville, on I think it was between 77th and 78th on 2nd Avenue. It was a little over $10 million total transaction. We wrote a little over a $2 million check for that deal. 22 units, was getting a significant rehab done on the property. The rehab on that property was already underway. We were placing other equity in that deal, which is great. There was proof of the business plan already happening. It was already, the risk of getting things started and finding partners and getting construction underway, right, was eliminated. We presented that opportunity, and within, I think it was 6 days, we were fully committed.
The yeah, one of the things that we did ahead of the webinar was to share with students some of the commentary that you've shared in the market or offered in the market with regard to sort of where we are with crowdfunding now. Before we jump on that, two more questions related to sort of the nascence of the firm. One is, when you did choose that initial deal, was there some thought around, was part of your selection criteria that, hey, this is really the deal that we want to go live with? When we launch this platform, this deal makes sense. And what was it about this particular opportunity that really just made it a good fit to be your debut?
Yeah, so one, we already knew about it. It was within the Arbor family of companies, so we had access to it. We liked the location, the business plan, the fact, like I said, that the deal was already underway in a proven market. Was a big testament to what we thought and how it could perform and how it would eventually perform. So being that we had a connection to it, being that it was in New York on the Upper East Side, being that, the deal was already underway, construction was already in progress, right, in a proven market, it was a no-brainer for us.
One of the guests on the call today outside of the United States says, I'm in India. Can I be an investor on the platform? Or do you actually need to be accredited, non-accredited, but resident here in the United States?
We get that question all the time. Today, we are only accepting accredited investors from people who are in the United States or have investment vehicles set up in the United States. That's what we're open to right now.
Got it. And again, there are 4 or 5 questions that we haven't gotten to yet on sort of the beginnings of the company. How what the returns look like, how to scale, so, who some of the competitors are that are outside of the crowdfunding space specifically. If we don't get to it today, we'll make sure to follow up. Adam, early 2020, we've heard about coronavirus or the emergence of a new virus in China. It hasn't directly impacted the United States or many of the Western economies early in the year. Where was crowdfunding early this year as compared to 2017 when things were just getting off the ground for you? How did it evolve?
It had evolved to a place where there were definitely more players in the space. There was some consolidation. Like I said, costs were high for the industry. So, eventually, if you're VC backed and you're not showing a great amount of return to those companies or progress, right, funding will dry up. You have a couple deals perform badly, your reputation gets hit very hard, right? So we're already seeing some sort of consolidation. That's something I also actively talk about, how this industry will consolidate when things turn. But there was a lot of competition, a lot of deals that we had passed on, right? We were seeing being launched on other platforms, marketed really differently than how we underwrote it or looked at those as, it's a small industry. Deals get passed around. People see, same opportunities come across their desks. And, I thought that the industry was quite aggressive. I think that it's growing a little bit too quickly in that how it's trying to have such broad and mass appeal, right? And, I think it needs to take a step back, take a step towards responsibility. And, I was talking about that at the beginning of the year in forecasting our outlook and saying, I think, a recession is going to hit soon. Many people think that. I think this industry is going to be incredibly challenged when it does because of the way that they look at deals and present them. And whenever that happens, right, I think there will be even more consolidation and it will be a test to weather that storm. Now, fast forward to where we are.
In terms of adopting a strategy that limits the immediate and aggressive move to scale, but perhaps focuses on an investment in credibility and deals done right, if it's okay for me to characterize it that way, and in building your investor capacity, your investor base, I imagine that a big part of your strategy might then be repeat investment of the deals that you've done. How often are you getting, an investor coming back to say, you know what, I had a good experience investing in a deal with Arbor Crowd, and I'm going to look at the next opportunity that they're bringing to the platform.
Our investors on average invest in 3 deals. That's our sweet spot. Many have been invested in 5 or 6. And that's an incredible number. In 2 or more, I think we're almost at we're just shy of I think it's 45%. We're just shy of 2 or more. And that's crazy. And that's different than a dollar number. That's just a repeat number. Um, and that's just a testament to them liking our product. And I'll admit, there's a great amount of pressure when people are saying, hey, why don't you launch more deals? When you have investors reaching out saying, we want more opportunities, when you have people registering for accounts, right, who become a part of your community, and we can talk about what it's like to nurture those people, attract new customers, right? When you don't have a live deal, it's a whole different strategy. But who want opportunities? You see your competitors going and going and going and going very quickly. There's a lot of pressure, right? But we recognize that the longevity would be in our own success, right? Our investors' success and our successful track record around our deals. So we were pretty tight. We took things slowly. We have deals. We launched a deal this year. We have one, a few that we've warehoused now, and we're still looking at deals actively. We're just not putting any on the platform just yet because of where we are in the uncertainty around us.
Sure. And I see we have about 10 unanswered questions right now. Again, we will get back to you as long as when you registered, we have a verifiable email address on file for you. So if you don't hear back from us, that's why. Just get in touch with us directly, and we'll make sure to follow up on your question. So that was where we were beginning 2020. Things are a little bit aggressive. You're concerned about the potential for an inflection in the business cycle. Um, Although sort of we were still having sort of a broad debate around what the proximate cause of that inflection might be. We certainly didn't necessarily, we weren't making bets that it would be a global pandemic. Come mid-March, that's exactly where we are. How has crowdfunding, not just Arbor Crowd, but crowdfunding as a platform and as a source of capital to real estate been impacted by the current crisis?
So I'll reiterate what you said. Nobody could have anticipated what is happening right now. And part of the word pandemic means that it affects everybody. So you could have weathered enormous storms in the past, different cycles, but depending on where your investments and what your investments are, this is affecting you and ourselves included. Now, if you had good practices in place, good partners in place, adaptability is huge, right? Relationships in place. You can go to your lender and say, I'm going to have issues with my mortgage payment. Are you willing to work with me? I know we can all talk about forbearance, right? And what that means and how that's being implemented. I'll admit it's pretty sloppy, and especially as it relates to, what we're commonly seeing on the moratorium on evictions and the lack of matchup and the time periods there will be issues, right? And the time period around those issues are yet to be identified. But if you can go to your lender even, right, and you have a good relationship with them and you've proven to do well with them in the past, and you can say, hey, let's work together, right? How can you help me? I'm having some issues. What are my options? Those are big deals to be able to have. So it's affecting everyone. If you underwrote, a little more conservatively, you anticipated that a downturn could be coming, you have relationships and you have expertise, right? You will fare better than others. You will. And depending on how you're leveraged, you'll also fare better.
So, how active a role does Arbor Crowd take in ensuring that the borrowers, the owners of the properties, are stable, have the expertise in place to be able to manage the assets during a period of stress? And one of the things that we've seen, not necessarily with the Arbor Crowd platform specifically, but really across the board, if it might be small to medium-sized multifamily assets, there are investors and owners operators out there who may not have owned an asset during a period of weakness in the broader market. So, how active a role is ArborCrowd taking in situations?
So on the upfront, like I said, it's all about who you partner with, right? And their capabilities. So on the one hand, we believe we partnered with strong people who they know how to handle these situations and they know how to have conversations with us, right? To get ideas, to circulate ideas, but ultimately know how to adapt. And that's part of choosing the right sponsors. Now, what's different about our platform is that we believe our relationship with our investors starts once an investment starts. It doesn't end then, right? We don't have their money and we say, have a nice day. We say our relationship has just started, the investment has just started. What does that mean? We asset manage our transactions on behalf of our investors. We have the capabilities and the expertise to discuss with sponsors, get reports regularly, discuss with them what's happening on each property, and communicate that with our investors. And in the event, let's say, one of our sponsors wanted to go a certain route that differed from the original business plan that we had entered into, we have the expertise to say to that sponsor, hey, it might be opportune for us to go our separate ways at this point, right? Do you want to buy us out? Do we want to replace, our equity with other equity that may be available, right? Whatever that may be, right? We are able to have those conversations with our sophisticated partners because we have that experience, because we have the ability to asset manage these transactions. And that's a really big deal. Now, pivoting to where the rest of the industry is, I cannot speak to all of their conversations that are happening behind the scenes, but I can speak to the fact that without experience, without being able to pick good partners, which unfortunately, crowdfunding as a whole, because everybody recognizes that the money's cheap coming from crowdfunding companies in the commercial real estate space, and there's not a great amount of experience to question you. If you work in commercial real estate and you weren't able to get capital from a bank, from your high net worth investors, or go the traditional routes, the bottom of the barrel has been crowdfunding, and that's not acceptable, right? So the partners and the types of deals that are on other platforms right now are not the top quality opportunities that are out there, unfortunately. And I think that problem is going to be really tested in a time period like this.
Right. So, I mean, part of the answer may be what you described, that not in not putting deals on the platform right now. We shared with students an article that you had commented on just last week, where you described that it may be an appropriate time for a pause in crowdfunding. I don't want to mischaracterize your observations. So, where do you see crowdfunding and its role during the pandemic?
Yeah. So when I say pause, I mean a pause on putting deals on your platform. Like I said, we're still investing in deals. We have deals that we've warehoused that we're not going to launch until after, the dust settles. Why? Because we're in a time period of uncertainty. When I see, which is happening, platforms, when I see it, are launching deals in this environment, that is irresponsible. That is irresponsible to your investors. You do not know how the dust is going to settle. We do not know how long this is going to last. We do not know what payments on each property are going to look like from tenants. We don't know how different markets are going to be hit, right? We don't know what the future aid packages are going to look like and help this industry. With all that unknown, how could you have people come in and invest in an investment as it stands today when the environment is changing so rapidly, right? And we don't know exactly where it's going to end up. I think that's irresponsible. So when I say a pause on crowdfunding, I mean, take a pause on raising money, because that's what everybody else is doing. That's what the whole landscape is looking like. You know how hard it is, right, to even get debt. There's such a dry up of liquidity right now, right? You can be raising money if you're able to in the background, but you're not making investments yet. You're waiting to see what happens. And that's what I mean by a pause.
So we have just a minute or two left. What does crowdfunding look like once we see the economy, the labor market, capital markets begin to return to some degree of normalcy? And I realize, certainly as an economist, all of my models are characterized by a tremendous degree of uncertainty, and the same is true for all of us. To the best we can say, how might crowdfunding look different as we move forward?
Yeah. So to echo what your points, we don't know exactly, but what I was talking about earlier in the year, pre-pandemic, and nobody could have anticipated this, right, was a recession that was going to happen. And what I was saying was that in a recession, I think the crowdfunding space is going to be tested. There's going to be a lot of issue. There's going to be platforms that go out of business, which has started a little bit already, right? And there's going to be a level of consolidation. I think that will continue to happen. I think even if you look at VC companies and the types of money that they're looking to back, the types of cash they have on hand, they're going to be reevaluating all of their investments and how they want to keep funding them and what they don't want to keep funding. And crowdfunding falls into that bucket, right? So it's a hybrid industry with weird sources of capital backing it, or different sources of capital backing it, right? And already questionable investments that exist with questionable experience behind them.
Adam, thanks so much for joining. We're just about out of time.
Thanks for having me. And like I said, I'm happy to answer any additional questions offline.
Thank you. So we have more than a dozen that we didn't get to. And again, if we, for listeners, for students, if we don't get back to you on your question, it's because we don't have a verifiable email address associated with your registration for the webinar. If you don't hear from us, please reach out to us directly, and we'll make sure that we put you in touch with the right person to get back to you. Faculty who are participating in or listening in on today's webinar, if you'd like to use the Arbor Crowd real estate crowdfunding case study prepared by the Schack Institute in your academic institution or for your class this summer, this fall, please do let us know, and we'll be happy to make arrangements for that, and we'll be able to make that case study available for your institution to use at no cost this fall and this summer coming up. Thanks again to everyone who's joined us, and to Adam. The replay will be available in the next day or two on the NYU Schack platform. So look for a thank you note, not only with the replay, but a copy of the case study again as well. Thanks, everyone. Have a wonderful day.